Shoot your questions. If you guys can hear me, see me, I left a message in the chat, so let me know if you can hear me and see me okay. And if you can, yeah, let's go ahead with it. Just ask me anything that you guys want me to analyze, to discuss. By all means, let's talk about it. Good question. Okay, so this is interesting, and thank you so much for joining the chat, and I hope you gain value from it. I Before I invested in Lululemon, I compared Lulu and Nike, and I still think I have the spreadsheet right here. Let me have a look. Oh, yes, I do. Wait, hold on a second. Let me see if I can share my screen. Let me share my screen. Okay, so entire screen. Right. So cool. It looks like this was already prepared for your question. But no, but look, I have this here for a while because I was comparing companies in the main competitors of Lululemon, right? And of course, the first names that came up were, of course, Nike, Adidas. Both of them have by far the largest market share. So why did I pick Lululemon instead of a company like Nike? Nike's mode is more so. Nike is a well-established business, right? It goes back many decades, and so the mode is definitely more entrenched. But the reason I prefer Lululemon was because number one, the company still has plenty of reinvestment opportunities ahead, so they not that many years. So they only started their international expansion like a decade ago. Okay, and they still have plenty of room to growth internationally, unlike Nike, in my opinion, right? And so that was one of the things. That was one of the things. But then the most important thing is the metrics that Lululemon boosts are far better than Nike's. Okay, so for example, look, by far the most important metric for me is the ROI's, return on invested capital, and look at Lululemon's ROI's compared to that of Nike, for example. Okay, and it goes, for example, even if you scroll left, in fact, scroll right, you can see that Lululemon is also much better from a margin standpoint. So how much can the company translate into actual profits from revenues? And you can see, for example, that it sits at about 15% versus only 5% for Nike, and they have a much healthier balance sheet as well. And you can see that they have grown far more attractively in the past, and I do expect that to continue well into the future. And so, from a valuation standpoint, you can see that also that Lululemon is priced more attractively compared to Nike. And so I believe it's the better play. Okay. And because one of my criteria is I want to invest in a company that still has of plenty of growth ahead. I don't like. I try with Nike, for example. You can see that over the last several years, the company has only grown at about the same rate of the economy, like 3-4% per year. To me, that's not really enough because I like companies to continue to compound attractively over time, in hopes I don't have to sell them certainly in the next 4 or 5 years. All right. And I don't see that with Nike, right? But that said, I still think, not least because Nike, as I mentioned, is more expensive at current levels. But when I started comparing them, Nike was relatively cheap. And so I did have the chance to invest in both, but because I run a concentrated portfolio, I could only pick one, and I went with Lululemon. I like the company better, and so yeah. I mean, does that make sense? Did you like my explanation? Let me stop sharing this. Can see more people are joining the call. Awesome, perfect. Yeah, I'm. Look, It's Nike is a great business once again, and I think at these levels you can still achieve good returns on your money, just not the kind of returns that I'm hoping to achieve. And what does that mean? It means that if I want to double my money every 4 to 5 years, I need to compound money at 15% per year. Can Nike give me those kind of returns based on its current valuation? I don't think so. And I don't see how the company can grow its revenues, for example, it will never happen. I don't see how they can grow revenues at 10% per year over the next 5 or 10 years. It's just not going to happen. And so I prefer the economics of Lulu. Okay. Okay, we have another question. Have you looked into eToro stock? No, I have not. 2.5 billion market cap, sitting on 1 billion cash, 10 times forward PE. Let's have a look at that. Okay, so eToro. It's interesting because I use the platform only for educational resources. So if you guys are following the channel, then I always try to convey this message. It's important because interactive brokers may look complex, especially for someone who's just getting started. Let's have a look. Let me share my screen. I don't really like brokers, and the reason is if you look at some of them, if you look at the performance over the last several years, probably with the exception of interactive brokers, which has been an absolutely stunner, right? Well, how can I say? In terms of the returns they've generated over the last years, they are probably the only exception. And so I don't really like the business that much. It's quite cyclical as well, right? So think about it. At a time when everybody in a bull market, when everybody's trading as if like there's no tomorrow, crypto, FOMO, all these meme stocks, then these brokers tend to do very well. But then in a bear market, right? If we do get into a bear market, I mean, eventually we will get into one because we can't be in a bull market forever. Then they tend to struggle. So it's quite cyclical. I try to avoid a lot of cyclicality, if that makes sense, because over the long term, if you want to invest a company in hopes of never having to selling it, then you want to minimize your exposure to cyclical business. But let me share my screen here and let's see what the financials look like. Okay, so let's see. I can see that Stock Unlock doesn't even have a score for them. Why is that? Yeah, and this is another problem, right? So eToro, look, I mean, when did these? Yeah. So the IPO was only recently. I don't invest in companies that don't have solid track records, just because I like to see consistency in the numbers going back 10 years, 7 years at least. I don't have that with eToro. That said, yes, so you have a forward PE of 10, so it's relatively cheap. Look at the free cash flow yield at almost 13%. But what you have to understand is, do they have a moat? What exactly makes eToro different from all the other brokers? So these are the questions that you have to understand, because I mean, look, so for example, total revenues, I can only see this going back to 2020. Yes, of course, I mean, it's been going up on a quarterly basis. This is good. Let me check earnings. Okay, so we have a down here in 2021. Now it seems to it seems to be creeping back up. But you know what I mean? Look at inconsistency here. Let's have a look at free cash flows. Again, look, negative, up, now it's quite sharply lower. I can't understand what the moat is, and I don't see any kind of consistency in the fundamentals, because the company doesn't have a long-term track record. And so this is one of those that for me at least, it's an easy pass. Okay, I hope it makes sense. Schiller PE ratio, Buffett indicator. Buffett, yeah, all points on very high valuation. Mark, what's your opinion? I completely agree. I completely agree. In fact, I was sharing this with a few clients the other day. Let me see if I still have that here. Um, look at that. I mean, this is it's a big reason. I think I keep telling you guys this. I think if you are invested in the S&P, or right, most people are investing in the S&P, so they follow the S&P, they track the S&P returns by investing in a low cost index fund, right? And if you are doing that, I think chances are that over the next 5 or 10 years, you are going to see muted returns. Okay. And I know this may come to you as a bit of a shock, because we are so used to 15% returns, right? This is because that has been the performance of the S&P over the last 15 years, which is staggering if you think about it, for a passive investing strategy. So it shouldn't be that easy for us to make money, right? And so 15% returns over the last 15 years, or excuse me, over the last 15 years is absolutely mental. And it explains why so many fund managers have had a hard time outperforming the index. But what happens is, if I show you, for example, the levels of market concentration right now, okay, in fact, before I do that, let me share the research that was put out by JP Morgan, in case you missed some of my previous videos here on the channel. Look at this. Okay, look, forward PE and subsequent 5-year annualized returns. This was put out by JP Morgan Asset Management recently. You can go look it up, and according to what they say, they are projecting zero returns over the next 5 years, right? And this is what happens when you start investing in a market that is so overvalued. All right. So this is very important, guys. Don't fall into what we call recency bias. What does that mean? It means that just because the past 15 years have been great, you assume that the next 10 or 15 years are going to be equally great. Look at the S&P over time. We forget there are periods when you had to wait 25 years to break even, 9 years to break even, 12 years to break even. All right. And now we are in the longest bull market in history, that goes back to the global financial crisis. From that point onwards, I mean, it was always up and up and up, 15% annualized returns. I don't think this is going to continue going forward, right? In addition, not only is this one of the most expensive markets, but you also so it's also one of the most concentrated markets in history. So, for example, where is this? Let me show you this right here. Yeah, look, periods of extreme concentration. Look at that. You had to go back to 1935, well, to 1932, to see a market that was this concentrated, right? It goes back to 2020. So this is from 1925 all the way to 2030, 23. You know, look at this, absolutely mental, right? So, and look at this one. Where is valuation levels? I wanted to show you something pretty cool. Yeah, look at this. Tech companies with no revenues or profits are also flying, as are the Max 7. The rest are left in the shade. Okay. Again, another very telling research that was put out by Schroders. You can see that Nasdaq, no revenues. I mean, can you believe this stuff? So companies that don't, we are not even talking about making profits, just revenues. Nasdaq, no revenues, is going through the roof, while the Max 7 as well. And then the companies that are actually profitable are again left in the shade. I don't think, unless you think this is going to continue, which I certainly don't, this market is very, very risky, because it has been transformed into a complete gambling machine. And yeah, and look, you mentioned the Shiller PE ratio. You can see that the Shiller PE again is at nosebleed levels, right? But then you can make the case that the Shiller PE has been going higher ever since 2008, for sure. That's true, right? But again, we play the probabilities game. And so, what are the probabilities of the PE continuing to expand going forward? Do you think that is going to be the case, or do you think the probabilities are tilting to this actually rolling over to a more sustainable valuation level? Again, I don't know. I don't try to predict the markets. What I do know is two things: the highest concentrated market in history and one of the most expensive markets in history. You can see that the top 10 um, you can see that the top 10 companies in the S&P have generated about 40% of the S&P 500 returns, right? Uh, yeah, almost 38, yeah, 38% of the S&P 500 returns in June 2024. This is incredible. I mean, this has never happened. What do you think will happen if one of them or two of them falter, right? Like we saw with Microsoft, for example, like 2 or 3 days ago, they delivered a standout earnings quarter, but what happened is it wasn't enough to live up to exuberant expectations, and that's why the stock crashed 12, 13%, and it dragged down the entire market with it, right? Again, there is I don't try I'm not in the business of trying to predict the markets. I think if you stick with a sound framework and you invest in well-established companies with proven track records that generate a lot of shareholder value over time, and if you buy them at a good price, you're going to make a lot of money. Okay. And so I can show you. I just want to wrap up with this a screenshot that I took the other day, and you can see that revenue mode trades. Look at that. You can see that quality will outperform over time. This one is more. This one, yeah, it's easier to understand. Quality at reasonable price usually will out. I mean, tends to outperform. Right. This goes back to the early 90s, all the way through through the 2020s. You can see that that quality at reasonable price will tend to outperform the markets. Do I follow this strategy? Not necessarily, because I don't want to buy at a reasonable price. All right, I want to buy it at a great price, and that's why I'm not buying every single day. Right, you try to buy high quality companies when they go through periods of uncertainty, and I don't believe in that nonsense of paying a fair value. I think if you have a basket of 15 or 20 companies, you will do well with that strategy over time, for sure. That's not for me though, because I want to double money every 4 to 5 years or sooner, and to achieve that kind of returns on my investments, I need quality, and I need quality at a great price. So I hope I this makes sense. How much do you condition in macro situation changes in your long-term holding? Um, if you, I think it was Warren Buffett who said this. If you buy, if you buy a company, if you buy a company at a great price, you only have to worry about the company. If you buy a company at an expensive price, you have to worry about the company and the country. And I mean, I believe I understand where he's coming from, but the reality is that I don't take unnecessary risk. So you won't find me investing in third world countries, right? I like to invest in well-developed nations, but and because of transparency, because of regulations, the accounting is like I said, the accounting is more transparent, more reliable, and so I would avoid investing in certain countries. However, do I factor macro challenges into the picture? No, because I only buy when the companies are already so depressed that they are already factoring in a lot of headwinds. A lot of headwinds are already baked into the stock price. I have a huge margin of safety So you have a big gap between what the value of the company is in what the market is pricing it at. Okay, and so that's it. So, for example, I did that with, for example, Alibaba, as you guys probably know, right? Alibaba was a company that 3 years ago people were calling China uninvestable. I call it BS. I saw a company that was sitting on. They were generating $20 billion in free cash flow every year. They had a net cash position at the time, and the company was pressed as though it was not going to grow going forward. I never bought into that nonsense. People were calling China risky. However, I already had all that negativity built into the stock price. All it takes in these situations is a positive catalyst for the company to go ballistic. So what you have to understand is, okay, so what's going to be the catalyst? It can be a new CEO. It can be margins improving. It can be revenues reaccelerating, right? And these are the things that I try to assess before making a decision. And so if you look at the companies that I own, they all go through periods of what I call temporary setbacks that think I don't believe they are structural, but I demand a big margin of safety. Okay, so always demand a big margin of safety. And I can give you another great example, guys, now that you are here. And I'm going to make this very clear to all of you because this is a company that I've been analyzing recently, Constellation Software. Guys, pay attention to this. I cannot tell you how many quality investors have been telling all of us to invest in this company, right? It's a no-brainer, phenomenal company. It's never going to go cheap. Now the company, because of the advent of AI, right? The fears of AI disruption have caused the stock to crash 55, almost 60%. You see what I mean? Even great companies go through periods of uncertainty. You have to be patient. That's it. And then if the story hasn't changed, if you believe it's nothing structural, in the case of Constellation, if you believe AI is not going to be disruptive, you can buy a great business at a great price, right? And so I haven't come to that conclusion yet. I'm still in the process of doing more due diligence, but the software space has been decimated, and there's opportunity here for sure. Make sense? We have about 15 people on the chat. Guys, make more questions. Yeah, ask stuff. Yeah, let me know who you are. And thank you so much again for everything. I mean, that really means the world to me. The goal is to continue to expand, to put out more valuable content, and and we will see. I think. Oh, and by the way, if you so two of our companies report next week. We have PayPal and Evolution AB, and these two have been by far the main detractors from the main detractors in our portfolio. It's going to be I'm very curious to see how things will pan out, especially with Evolution AB, because I want to see uh, if they are really turning things around in Asia, because these cybersecurity problems have been dragging on for too long. So let's see. Yeah, I'll create videos on these companies and on the reports and conference calls next week, and I'm looking forward to it. What about you guys? I mean, do you concentrate or do diversify? What do you prefer? What's your take on this? Curious to hear your thoughts as well. 19 people right now. Let's go. Ask questions. Ask questions. Let's learn together. In fact, we were talking about constellation software. Let me show you this chart right here. Sebastian is asking which is the best opportunity you see right now in the markets. This market is at an important juncture, in my opinion. You have record high valuations, and when the and you can see that the big techs, so the magnificent seven, continue to drive most of the S&P 500 returns. They are very profitable and all of that stuff. Eventually, but what happens is the growth is slowing, but the valuation hasn't come down enough. uh, I see opportunities in small caps, even though that's not really my expertise, because I try to invest in well-established companies. But you guys can see that small caps relative to the S&P are trading at the cheapest, at one of the cheapest valuations in the last 20 plus years. You may have opportunity in small caps. In addition, small caps tend to outperform the market over the long term. That's one thing for you. Another thing for you is healthcare. Guys, so look, if you have an edge here, I many of my clients already invested in healthcare companies and they are doing phenomenally well. And I've been very transparent about it on the channel. For example, they I know many of them bought Novo Nordisk, right? So if I show you Novo Nordisk right here, I mean, I will go back to Constellation Software after this. But look at this nasty sell-off. Unbelievable, right? A company, they said it's exceptional, it's never go down. Look at that. Yeah, it won't be long before this thing is 60% down. Incredible. Okay, so now let's have a look at Novo Nordisk. This is going to be this has already made my clients a lot of money because we under they understood the business. We did the financial analysis, and they bought around 47. You can see the lines already drawn on the channel, right? So they bought it with a huge margin of safety, and this thing already went up 50%, I think. Yeah, or look, 45, 46%. And I think it will continue to go up. Now, so healthcare is very attractive. Okay, so if you have an edge here, if you understand, if you like the healthcare space, because then I think you can have a lot of opportunities right here. Let me show you right here. I wanted to show you something that I shared with the community the other day. Market valuation concentration. Look, this here, right here. Look. So healthcare is the cheapest it's been going back to the early 2000s. Okay, and we all know what happened afterwards. I think a similar situation is going to happen right now, and we are already seeing the turnaround happening in real time. So the question is, what companies do you pick? And the reason I don't invest in healthcare companies is because they don't meet my first number one criteria for investing in a company. I can't believe this. Wait, I'm not showing my screen. Oh, okay. Sorry about that. Um, Sorry about that. Let me go back here. Okay, so I was showing you Novo Nordisk, right? Novo Nordisk, look at that. So my clients bought around this level that you can see right here, 45. So they are already in the money, and this is going to be a long-term play. This was a no-brainer if you ask me. So there is opportunity in the healthcare space. This was a no-brainer because the company operates in a duopoly together with Eli Lilly, and I think the room for this thing to continue to grow is just incredible. And so if you understand the business, if you understand how they make money, then this was definitely a no-brainer because the financials were stellar. In the chart that I was showing you was this one right here. Let me show you this one. Look, healthcare the cheapest going back to 2000, and we all know what happened afterwards. Okay, so there is plenty of opportunity still in the healthcare space. There is plenty of opportunities in the software space right now, but be very cautious because you have to understand the moats. Understand the moats before investing. There is a reason why the software space has been trounced, right? Because of AI disruption fears, and I do think those fears are warranted because we will see a lot of disintermediation happening, but there will be companies that are going to come out stronger. I believe Constellation Software might be one of them. I'm still doing research. Don't quote me on that. But because they operate in the vertical market space, the so the technology is less broader, right, and more niche, and so they stand. I think it's going to be more difficult for AI to disrupt these companies. But again, I'm still doing research on that, and yeah, and look, you can always find pockets of the market that will be trading cheaper, and that's when you attack. But you have to understand the moat. Understand the moat. The valuation is just the first part of the equation. You have to understand the moat. And so whenever I put out videos, for example, on Uber, I mean, there's only so much that I can analyze, and just to give you a bit more visibility into the framework that I go through, in case you don't know it already, look at this. Let me share my screen. This is what I do. So this is the stock deep dives. This is my full investment process. For example, we did for Novo Nordisk. You see, I shared this with our clients, and you can see that I answer all of these questions. Do I understand the business model? Let me just zoom in on this. Is management capable? Does the company have a sustainable competitive advantage? Is the company active in an attractive end market? Let's explore this. My conclusion was, look at that. Obesities and diabetes epidemic, right? Type 2 diabetes cases are expected to reach 1.3 billion by 2050, up from 529 million in 2021. So, is the company active in an attractive end market? Why do I ask this? Because I want to see plenty of reinvestment opportunities for the company going forward. Okay, so yeah, look at that. The GLP obesity market is projected to grow from 30 billion in 2024 to 100 billion plus by 2032. That is a CAGR, a 20% CAGR. All right. This is very good. And because Novo Nordisk is one of the major operators in this space, do you think they stand to capture a lot of this growth? Yes, I do. I certainly do. But in this case, I didn't pull the trigger. Why? The reason I didn't do it is because of this. This is my framework, right? This is the winning formula that we always go through when choosing investments. And you can see that it starts with meaning. What does that mean? Is this a company I would like to own for the next 10 years? Is this a company that I understand? Is this a company whose values are aligned with mine? So why didn't I pull the trigger? Because I don't have an edge in the healthcare space. I don't understand it, and I find it boring. And for that reason, I don't invest in these companies because they don't interest me. And because I think like a business owner, I'm already thinking, okay, so if I'm going to invest in the company, this means I'm going to commit to check in with them on a quarterly basis whenever they report quarterly earnings, and I have to listen to the conference calls and all of that. Am I going to do that with something I don't like? The answer is no. My clients, on the other hand, those that invested in Novo, they like healthcare. So they check out the financials. It checked all the boxes. very cheap. They believed it was a temporary heroin versus a permanent structural issue. Boom, pull the trigger. You only need a few of these companies to make a lot of money. Okay. All right. So let me try to catch up. I hope I answered your question. Which is the best? Okay, I answered that. Um, Last question: how much cash in percentage to hold for an opportunity to show 50%, 30%? You mean in your portfolio? I typically like to have, I don't know. If you go above 10%, you are already, that's going to affect your returns going forward, and that means you are. I think 10-15% cash is fine. This is what we do. I think you can, because of our framework, I will only invest in companies with a big margin of safety, and it's difficult to find them in a market that is so expensive. However, as you saw right now with examples in real time, you can still find opportunities in an expensive market because there are pockets of the market that remain cheap, right? And so I will keep like 10-15% in case there is, for example, a recession. And if that is the case, all companies come down. I want to make that clear. And if you have been in the markets for a while, you know this is going to happen. Yes, if you buy with a 50% margin of safety, then the stock is already down 60%, 50%. However, in a bear market, everything comes down. Okay. And they will come down as well, together with the market. But the difference is they won't collapse as much. Okay. And that's why having some spare cash will allow you to take advantage of these opportunities, provided you have the balls to do that. Easier said than done. All right. I've seen this. I've seen people. It doesn't even have to be a bear market. I mean, look at PayPal. Right? Is the best possible example that I can show you guys. And I made it very transparent here in the channel that I bought more PayPal at $50 per share recently. They didn't quite reach my $50 mark because I wanted to bring my cost basis down. But let me show you. Let me give you another great example of PayPal, and let me open eToro right here so you guys can see this. Again, for the new joiners, remember eToro. I don't use eToro to execute transactions. I use interactive brokers, but eToro is easier to navigate, especially if you are just new. So let's see PayPal. Look, again, easier said than done, right? And people that are with me, they still asking me these questions because they know that I bought PayPal around $66. It's already the lines are already here. Okay, so very transparent. Look, $66 per share was the line at which I bought PayPal. So I'm already underwater, and I continue to buy right here on the way down. So I bought more yesterday around 54, and my cost basis is now at $63-$62 per share. Okay, so why did I do that? Because I don't think the fundamentals have changed. I still think the moat hasn't been breached. I think the fundamentals are improving, margins are reaccelerating, revenue is growing. The company is going to report in Q4, so next week. They were in last quarter. They were projecting for end of year free cash flows around 6.5 to 7 billion. This is the highest free cash flow levels in the company's history. Okay, and they are buying back stock like there's no tomorrow. So the fundamentals are improving. The price is going in the other direction. If you have the balls to act, and if you have fully conviction in your thesis, then you should buy more. Okay, again, easier said than done, because many people that I work with already know exactly how I go about building wealth, but they still need to ask me questions. And I think some of this will only come with experience. You have to go to the experience of people selling or of buying more on the way down, like I did with Alibaba. Here we go. look, another great example. Look at Alibaba, right? Let's use that as an example. Again, the dark line is already marked right here. This was my cost basis. I started buying in 2023 at 122, and I kept buying on the way down, all the way to 50 to 65. So I brought and I continued to accumulate right here when people were puking in the hole. I continued to accumulate. People were turning ultra bearish, but I never believed in that nonsense. The fundamentals were actually strong. I was getting great value for my money. And sure enough, look where we are right now. And you can see the red line marks the intrinsic value per my conservative assumptions. Okay. And I'm not selling a single share until this thing hits 260. Can it go back down? Of course. I don't have a crystal ball. So what happens if it comes back down? Well, I'm going to wait because the real value of the company hasn't been met yet. And so I'm not a trader. I'm a long-term investor. And this has made me money, and it will continue to make me money over time because this framework has been working for. Cool. I hope that makes sense. Okay. Stock symbol, and it shows my portfolio. Yes, I can. So I created a portfolio for transparency reasons, the company's portfolio. So let me show you that. Am I sharing my screen? No, I'm not. This probably shock you guys. I own 6 companies in this portfolio. Okay. Look, here we go. Okay, this is the dashboard. You can see that. So I've been compounding money at 25%. Look at the nasty drop recently because of the crash that we saw with LVMH. But over time, this will continue to outperform. And the reason is I own better quality companies trading at cheaper valuations compared to the overall index. If I go here to my positions, you can see that Lululemon, that was also up not that long ago, it shot up to 200, where my cost basis is. Look at that. You see, average price. This is where I got. This is what I entered, but then it collapsed with the market. Not least because they fucked up with some of the products that were released. Right, that issue with leggings is something that I don't like. That, by the way, that is something that I really don't like. Let me give you some transparency, not transparency. Let me give you some context to Lululemon. What happened to the stock? What caused the stock to crash 5% a few days ago? This was the problem. Look, not this. Where is it? Yeah, this nonsense. Look, through leggings are just another enforced error. So what happens is management wanted to. They are having issues in North America. Okay, so and the issues are they left the product development cycle to went on for too long, and so one of the solutions to that problem is to shorten, right, the product development cycle and release products faster. But the problem is that they are sacrificing quality, and sure enough, this is what I see right here, right? So what happens is if I open this news, you can see that they released a pair of leggings, right? And these leggings, when women do some moves, they can act. You can see through them, which is, I mean, come on, guys, you are charging a premium price for this for those pair of leggings. This shouldn't happen. This is a structural problem. Now they are in the process of finding another CEO, and so I'm going to wait for the next CEO to come in and see what things will look like going forward. I didn't like this one bit, but again, we still have a lot of skin in the game because the former CEO and founder still has about over he has 2 billion invested in the company. He's pushing for changes on the board, and we also have a big Elliott, right? So the activist investor, he bought $1 billion stake in the company, and according to the news, they are in charge of finding a new CEO. I like, again, these all you have the factors that are important for the turnaround to happen. Now let's see if it's gonna continue. Okay. And so what else do I have in the portfolio? So we discussed Lululemon. I already told you guys about PayPal very transparently. Look at that. Again, you can see very honestly that I was buying this stuff yesterday. Look, if I show you right here, what day is today? January 31st. Okay. Why? Where is this? Mm, I bought this stuff yesterday. Ah, right here. Okay, right here. Look, at the price of 52. Okay, so people puking in the hole. This thesis has been broken. Blah blah blah. More competition. Blah blah blah. What I see is fundamentals improving. My conviction has not changed, so I decided to pull the trigger on this. Okay, they are reporting earnings on Tuesday. We will see how it comes, how that happens, or how that what they have in store for us. But look, what can I say? I only invest in companies that I have a high conviction in. It happened to Ulta. It happened to LVMH. This one reported earnings 2 days ago. The stock got smoked, right? However, this is a family-owned business. 50% of the wealth is tied into the company, right? I bought at around 477. Again, when people were calling this company an investable, look at some of the headlines. It was down 50%, big margin of safety. Now you can see this was my average price, and now I'm waiting because in this I think is going to be another long-term investment that I won't have to sell. So why is this thing coming down? Number one, currency effects. So currency headwinds, they generate over 50% of their revenues in China and in the US, because the US, the dollar has been selling off. That is hitting their margins in growth as well. Okay, and so I don't think this is not structural. I do think this is permanent, and I think there will always be demand for what they want, for what they sell. Because as I put out as well a full deep dive on LVMH. What can I say? They are the largest luxury empire in the world. Okay, look at this, the biggest luxury business empire. Look at all these brands, guys. You want to, I mean, this is a great company led by an outstanding management team, and they have been around for decades, and they will continue to deliver great value for the next many years. Okay, so I'm not selling. That's it. And then, yeah, so you can see the main detractors are by far Evolution and PayPal, both of which report earnings next week. So here we go. Oh wow, many things here. Okay, possibly yes. If could you please share a spreadsheet where you can input stock symbol and it shows fair value by different methods? Thank you. I can do that. Yeah, I don't. I haven't created that yet because I always use this, and this is something that I only share with partners and clients. But you can see that in many of my videos, I put you already have a spreadsheet that I use to calculate both the DCF and the reverse DCF, and that is this one right here. Why is this? This one. So you can see, right? So this I already shared this sheet. You can find it in the comment section of every video, right? It's the DCF that I built, and you guys can access it. It's pretty cool. Okay. Now this sheet right here, this is the one that I use, but I use it for clients as well. For clients, so you can see that we have, for example, the most important items on the balance sheet, on the income statement, cash flow, and then I have stuff that I like to look at. For example, valuation ratios, returns on capital, margins, right? And then here below, I use Phil Town's 3 valuation methods as well: the margin of safety, the 10 cap rate, and last but not least, the payback time. And that's it. So these are the only spreadsheets that I use. I don't think you need more than that. And let's be fair, guys. I mean, coming calculating the real value of a company is not a big deal. Everybody can do that. My mom can do that, and she doesn't have any finance background either. I don't have it either. I mean, everybody can do this stuff, and this is what makes investing intellectually stimulating. It's because investing is both an art as a science. You can be the most intelligent person in the world, coming up with all the fancy spreadsheets, and you are going to do, and you can do terribly as an investor. And don't, I mean, I was sharing this again with a client yesterday. I mean, look at this nonsense. I mean, can you believe this stuff? I mean, look at this. Look, Isaac Newton, you was by, legit. You can't make this stuff. You can look this up if you want. But the big difference between average investors and great investors comes down to behavior, not information, not intelligence, not tools. Look, Newton invests a bit in this. This is the South Sea bubble. He invested a bit right here. He exited happy. However, his friends continued invested and were making a ton of money, right? So Newton FOMOed back into the market at the peak of the South Sea bubble, and then the bubble burst. He exited broke. Do you think Newton was a smart guy, was intelligent? Hell yeah, right? One of the highest IQs ever. However, he was not temperamentally suited to be an investor. And this is one of the things that I will try to pound the table on. We all need to be temperamentally suited to do this kind of stuff. Okay. And for example, one of the things I think you will gain value from this as well. Look at that. This is one of the things that I shared in our WhatsApp group. Look at that. A few sessions this morning with some of you reminded me how important patience really is. My goal is not only for you to become capable of finding great companies on your own and feel completely comfortable managing your own money, but also to become emotionally resilient. You must invest with your brain, not your emotions. The best way to achieve this is understand what you own, because if you don't understand PayPal while the company is selling off, you are going to shit yourself in the pants, and you are going to buy when you should be selling, and you are going to sell when you should be buying. So if you can't clearly explain how the company makes money, you shouldn't be investing in it. Demand a margin of safety. Never buy anything without one. If you estimate the company's intrinsic value at $100 per share, only buy at $50 per share. Great things happen when you buy $1 for 50 cents, okay? Charlie Munger says investors who cannot handle market volatility deserve the mediocre results they will eventually get. And I completely agree with his words. Okay, what else do we have here? Some of my holdings that seem undervalued. Hello, PayPal, Adobe. Adobe is a good one, man. Again, the reason I haven't pulled the trigger on Adobe is because I don't understand. I'm not comfortable that the company is not going to be disintermediated by AI. The financials look amazing. So if I were going to make a decision solely based on the financials of the company, I would buy the company on Monday. The financials look amazing. I'm not comfortable that what they do is not going to be done by AI. Okay. And this is the problem. You guys can find, I'm pretty sure that we can find great value in the software market, in the software space right now. Look at my video on the sell-off in the software space, and you can see the difference between vertical markets, between vertical software and horizontal software. Everything that falls into the horizontal software category, in my opinion, I would stay away from it. But the vertical market software, this is more attractive. I think because what the kind of software that they create is very niche. All right. So they serve mission critical. They sell mission critical software that is much harder to be displaced. And so I think you can find value there. I'm not comfortable with a company like Adobe. The other companies, I'm gonna have to make a note. I think I already discussed Hallow. If I haven't, let me make a note here. for future video content. Let me see. Okay, so Allo, Afaya, Adobe, KSPI. Is that crisp? No, wait. KSPI. I'm going to look at one of them because we have more people asking questions as well. So let me see. Let's start with, I don't know, let's do this one, KSPY. Let's do this one. KSPY, what is this? Are you investing? Let me check this. So, okay, let's see what they do. A Japanese KSPY, Japanese company. Okay. Let me see. Okay, so they IPO'd in 2018. I have at least 7 years of data, so that's fine. Consumer finance, what do they do? Consumer finance industry. The company is headquartered in Kazakhstan-based Kazakh. Okay, let's have a look. Okay, Stock and Lock gives them a 4.73 score out of 5, which is pretty solid. Let's have a look. I'm pretty sure the total revenues, look at that, 46%. Great earnings. Let's have a look at the balance sheet. Do they have a lot of debt? No. Well, long-term debt is actually coming down, which is great to see. This is on a quarterly basis. I like to see that. Let me see here. I hate juggling two different stock analysis platforms, but unfortunately, I don't see everything that I like in a single platform, which is why I built this sheet so I can just pull everything that I want together into a single sheet and avoid a lot of jumping around. Let me see. Are they here? Okay, cool. What do we have here? Oh wow, great earnings yield. Okay, so they are cheap from a valuation standpoint. The problem is what? Is it the country? Provides payments marketplace in fintech solutions for consumers. Payments marketplace in fintech. Man, I would stick with PayPal. Certainly in the payment space. Why is this thing only going back to 2024? I don't know. I don't like that. But the company IPO'd much. Yeah, they don't give me a chart going back many years. I don't know why. Okay, so I want to see some of this. Let me check the balance sheet. Let's go to statistics. Balance sheet. Okay, so they have a net cash position, which is very good. Generating this much in revenue. The free cash flow is solid. Margins are also solid. Look at that profit margin around 30%. Great returns on capital as well. So you have to understand what the competition looks like. This is where, so even if it look from a financial standpoint, this thing looks great. If I go to the income statement, trailing 12 months, let me check the shares outstanding. Okay, they have been stable, which is good. So they are not diluting existing shareholders. I understand why they have such a high score right here, right? So look at that: profitability 5, management 5, growth about 5, financial health 4. They give it a 4. I would actually give it a 5. Analysts look bullish. So if I go to the statistics, look at analysts' growth estimates. They don't. Here it's NA. I don't know why. Let me have a look at earnings per share for the last several years. Quarterly. Let's do quarter. Earnings per share diluted. It's going up. Yeah. So again, so you have to understand the moat, right? What is the moat here? Why? What are the odds of them being disrupted? What's the competitive advantage? Those are the things that you would have to understand. But from a financial standpoint, it's yeah, it means that the work starts now, right? Understand again, management, are they aligned with shareholders? Do they have a lot of skin in the game? What's the insider ownership? Do you think what's the competition like? What's the moat like? Check what customers are saying about them. Do they like? Those are the questions that you should be asking. Then we have those companies. FTNT is undervalued. That's another company that I will note down because just for we are already overrunning here. FT, 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 FT. Okay, FTNT. FTNT. Is that Fortnite? Is that Fortnite? If it's Fortnite, I understand why you are interested in that stuff. Yes, it's Fortnite. Yes, I understand this one. This one. So this company was another darling, right? And now it's coming down. It's off the highs. Probably not off enough. But this is a company that I can analyze as well. But yeah, I think they are in the cybersecurity space, aren't they? Enterprise, yeah, cybersecurity, yes. So I understand why you are interested in this company. I think it's a solid company. I just don't think. Look at the insider ownership. So they have about almost 18% insider ownership. So I like that, and I can see that there's a lot of buying as well. Yeah, I understand why you are interested in the company. I just don't think you have a big enough margin of safety. I noted that down. I can make a video on them. Yes, insider ownership. Exactly. According to the method I used, and please take it with a grain of salt since this is rather new. Okay. Around 25% undervalue. I think cybersecurity will be important in the future. You are right. Cybersecurity will be important, especially with AI, right? Especially with AI. And that's why many of these companies in the AI space that are related to cybersecurity actually went higher because AI is going to create the demand for cybersecurity services. And Fortnite, as a core player in that space, tends to benefit. So good cash. But the point here is, can you get a good return on your investment going forward? And so this is where I would have to analyze as well, but I will create a video on them. Links, could you kindly consider sharing those two spreadsheets? So the spreadsheet, if you go back to my previous video, so if you go back to my previous video, the one that I released prior to doing this live, you can see the spreadsheet in the commentary section, and it's online and you can see it there. The other one is only for clients. Yes, I understand Oracle. The reason I don't invest in our Oracle. I'm gonna end with that. Yes, because no, it's not Japanese. Okay, thank you for that clarification. Thanks, Fortnite. Yes, correct. All right, so I will end on Oracle. Okay, and I will show you exactly why I wouldn't buy this company. Um, Even if it became cheaper. I'm going to show you why. Okay, look, here's why. I don't like the balance sheet. I don't like the balance sheet. I'm sharing my screen. So look, if I go here to the trailing 12 months, if I go here to the cash flow statements, number one, you can see that they generate this much in operating cash flows, right? Which is good. It means, okay, so this is a company whose operations generate money. That's all good. The problem is, look at the capex. Look at this. Okay, it's right now. Look, it exploded since May 2024, and the problem is what they are spending on capex greatly exceeds the operating cash flow that they are generating. Okay, so you have to ask yourself, so where are they going to take the money to fuel all this capex expenditure? And the answer is they have to borrow money. And if I go here to the long-term debt, you can see that the long-term debt is starting to tick up. All right, if I change this to the quarterly figures, to just zoom in on the latest, on the last quarterly meeting they had, quarterly reports, you can see the same thing. So, right, so it just jumped and it's set to continue. It's poised to continue to go up. And so this is a very levered balance sheet. Look at the total liabilities. Okay. They have more total assets, but look at that. So I don't like how much long-term debt they have relative to how much cash and cash equivalents that they have. All right. I don't like that. And if you look at the company like, for example, Microsoft, they are also doing a lot of capex, but look at the difference. Look at the operating cash flow, 160 billion. Look at the capex, 83 billion. So a company like Microsoft can afford to make mistakes, and because they, number one, they are diversified. Number two, they are using their own money, right? They generate enough money from operations to actually fuel that capex expenditure. That's okay. I don't like what the financials of Oracle look like. All right. I don't like how levered the balance sheet is. And in addition, if I come here to the balance sheet of Microsoft, look at that. Almost 90 billion in cash and cash equivalents. Okay. And if you look at their long-term debt, look at that. So if they wanted, they could pay all of their long-term debt with what? With less than a half of their cash position. Okay. They could wipe out all of their debt right on Monday if they wanted to. And so I like that. And if you are a long-term investor, then the unpredictability is the enemy of a long-term investor. Okay. And so if you look at a company like PayPal, for example, again, what does the balance sheet look like? Look at that. They have 10 billion, 10.7 billion in cash and cash equivalents, and they have about 11 billion in long-term debt. So if they wanted, on Monday, they could almost wipe out all of their long-term debt from cash and cash equivalents. Okay. And I like that. In addition, they will generate the highest level of free cash flows in history, right? Between 6.5 to 7 billion in free cash flows. So avoid companies, be aware of companies that have a lot of debt. Because remember, what happens if AI doesn't turn out to be as great as many people are making it look like it will be, right? So what happens if AI doesn't even if AI becomes great? So I think AI is going to be great for sure. But what makes you think that all this capex that Oracle is embarking on will actually deliver good returns in the future? Okay, I'm not sure if that is going to be the case. And I'm not sure if Oracle is going to be one of the major beneficiaries. So be careful, okay? I would stay away from a company like Oracle. So guys, thank you so much for showing up. I did my best to provide a ton of value. If you liked it, look, let me know in the comments. Continue to spread the words, and let's continue to grow. I want to share you something cool as well, just to wrap things up. Am I sharing this? Yes, I am. I'm buying. So my girlfriend bought 2 polos, and we will be designing our logo right here. Okay, so the Like a Toto's logo. So I bought 2 polos, and what else did I bought? I think she also purchased something else that you guys will see. So this is pretty cool. I want to continue to spread the word, and ultimately, if you guys can do the same and share your polos with your logos and send them, I will for sure, I will spread that across my own audience, because that would be pretty cool. Okay. Awesome. Thank you so much, guys. Enjoy the rest of your weekend, and let's see what next week has in store for us. Remember, two of those holdings, and I know some of you are invested in them as well. We have PayPal and we have Evolution. They will report. Let's see what that looks like. Enjoy the rest of your Saturday and speak to you very soon. Thank you so much for showing up.